Hi, this is Will Cook with the Will Cook Group. Welcome back to my video blog. Today we're going to talk about how inflation affects mortgage rates. With inflation and the housing market dominating headlines, it's important to understand how the two go hand in hand. When the rate of inflation is high, the Federal Reserve takes action, and they do this by raising the Fed funds rate. As a result, borrowing money becomes more expensive, and interest rates on things like car loans, credit cards, and mortgages go up. This does usually have an effect of driving inflation down, but it can also impact different markets, industries, and even the entire economy. So right now, the Fed is hoping to direct the U.S. to a soft landing in which inflation and growth slow, but the economy avoids a recession. Recent data supports that we're headed in that direction, but industries like technology, finance, and especially the housing market have felt the full force of higher interest rates. Here are the details. Inflation is at its lowest point since 2021. It is currently hovering around 3%, down from 4% in May, and the ultra-high peak of 9.1% in June of 2022. The current rate is the lowest it's been since March of 2021, but it's still higher than the Federal Reserve's target rate of 2%. The latest numbers released on August 10th showed that inflation rose 0.2% from June to July, mostly due to rising rent and gas prices. But core inflation is actually down, and that's significant. What is core inflation? Well, when the prices of everything started rising, did it seem like groceries and utility bills started rising the most? If you said yes, you're right. And it wasn't your imagination. That's because historically the prices of food and energy are very volatile, meaning that they're sensitive to changes in the global economy and they can rise and fall dramatically in a short amount of time. So core inflation measures the price inflation of goods and services excluding food and energy because of their volatility. That way, the national inflation rate won't be skewed dramatically by an outlier, and we can get a more accurate picture of inflation overall. What does this mean for the housing market and mortgage rates? Well, analysts believe that the Feds will stop raising rates. According to AP News, economists believe that the Fed will pause interest rate hikes if inflation trends downward. The next FOMC, or Federal Open Market Committee meeting, is in late September, so whether or not rates rise again will depend on what happens with inflation between now and then. According to Forbes, mortgage rates are likely to stay between 6 and 6.9% through the end of 2023. Even if the Fed stops raising the key interest rates, that won't necessarily equate to a drop in mortgage rates or even a freeze. This is because mortgage rates don't just track the federal funds rate. They also rely on the yield of the 10-year Treasury note, as well as investor expectations and other factors. Instead of waiting for mortgage rates to drop to buy or sell your home, it can often be a better choice to make the move now and refinance later. When rates drop, here's why. First, real estate values always appreciate in the long run. So even if values rise and fall in the short term, you'll face higher prices down the road if you wait. And two, if you move now, you'll start building equity. When you do that, you benefit from rising home values instead of struggling with prices that feel unattainable. If we can assist you with your move, your purchase, or your sale, we'd be happy to. Please feel free to reach out with a call, text, or an email. And we'd love to discuss your unique situation. If you have any other real estate related topics or questions that I can answer, also feel free to reach out with those as well. Thank you so much for watching. See you next time.